You may want to get money out of your 401k sooner than later, no matter what. In this episode, I'm going to address the question, should I cash out my 401k to buy real estate? I'm Doug Andrew, and I have a confession to make. I've never owned a 401k or an IRA, and I never will, and you'll understand why. I'm not a huge, big real estate investor. I do own probably more real estate than most Americans do, but it's how I own the real estate that makes all the difference. And you're going to learn in this episode that there are tax implications and tax advantages, both for 401ks and for purchasing real estate. I'm going to share with you that many people simply don't know what they don't know, and so you can't be aware of something you're not aware of. If you take money, if you cash out a 401k, you're going to trigger tax. Now, you can borrow from a 401k, but then you have to make payments back, or it is considered a withdrawal. And when you take money out of a 401k prior to the age of 59 and a half, generally there is a 10% penalty on top of the tax. When I'm actually filming this episode, we've had a year of COVID-19, and this is where the government has allowed people under the age of 59 and a half to access up to $100,000 if they suffered a hardship out of a 401k without a 10% penalty. So there's certain opportunities that arise where you can avoid the penalty, but there is a tax implication. You will still have to pay tax. And it's going to all show up in 1 year, except during the year 2020, you could spread it out over 3 years if you wanted to. Now, whether that is smart or not, you'll learn as we proceed. But real estate may be better, or it may not, but it all depends upon if you understand the three marvels of wealth accumulation and safe, positive leverage with full liquidity. Before I go into how to buy and own real estate the smart way, let me first of all debunk the myth that a 401k or an IRA or the like is a good way to save for your retirement. See, the original premise of putting money into a tax-deferred IRA or 401k is, you're going to be in a lower tax bracket when you retire. So it would be better to put in pre-tax contributions to a 401k or tax-deductible contributions to an IRA and let it accumulate tax-deferred, and you'll have more money. And then when you withdraw money in retirement, you're going to be in a lower bracket then. You can deal with it then. Well, folks, that has not been really true, or what I call axiomatic, for more than 25 years now. Most people who have saved a respectable retirement nest egg find themselves in as higher tax brackets as they were ever in during their earning years, because they saved a lot, and also they were killing their deductions along the way. Most retirees who have 401ks, they've paid off their house, so they don't have that tax deduction anymore, the interest deduction. During retirement, you're not contributing money to 401ks and IRAs, so you don't have that deduction anymore. If you owned a business, you don't have those deductions anymore. Your kids are gone, or if they're not gone, your adult children are still living with you, you can't deduct them anymore. And people find themselves paying higher taxes because Congress keeps getting greedy and raising taxes. So folks, it does not make sense to postpone and defer to some future perceived unknown advantage and then withdraw your money when most of us believe that future tax rates will be higher. That does not make sense. So in answering this question, should you cash out your 401k to buy real estate? I said, well, I think you ought to look at that sooner than later, no matter what. And if you want to buy real estate, I will share with you why and how you should own and manage your real estate different than what you've always thought or been taught. So let me share with you how to invest in real estate, what I feel is the smart way. And I'm going to use a metaphor here, the story of the three little pigs. But before doing so, if you do not stay to the end of this episode, which I encourage you to do, make sure to subscribe and click on the notification bell if you'd like, because I post a new educational video almost daily. There's also an opportunity at the end to claim your free copy of my most recent best-selling book called The Laser Fund, a 300-page book with all kinds of charts and graphs and explanations. And so you can go to laserfund.com to claim your free copy. Now, let me use the story of the three little pigs. If you remember, one of the pigs built a house made out of sticks, one out of straw, and one out of bricks. So I equate money invested in real estate as moderate risk, okay? It doesn't fluctuate as violently as money in the stock market. So I would call that, putting money in a house of sticks. It can still be blown down by the big bad wolf, and I'll share what the big bad wolf does and who that is. But that would be moderate risk, and that's real estate. Now, over here is the house of straw. This is what I would equate to the stock market because it's flimsy, sometimes within hours or a day based upon Federal Reserve announcements or whatever. The stock market can fluctuate and that house can be blown down in a matter of a day or two, like after the September 11th terrorist attacks in 2001. And so that is usually stocks, growth mutual funds, and so forth. That's higher risk. Now, the house of bricks is the lower risk investments. And that might include insurance contracts, annuities, bonds, certificates of deposit, money market accounts, and so forth. And some of those already, are pathetic with their rate of return. But the money is deemed fairly safe because it may have FDIC insurance or whatever. So you would be tucking your money in a house of bricks that has safety, but the rate of return may not be that great in some of these vehicles. Now, money has to have a home. So what I do, and if you read my books, you'll understand that I like to own real estate, but I don't like my equity tied up or at risk in the actual real estate. I own real estate, but I keep the equity over here safely tucked in a house of bricks. I get to participate when the stock market does well, but when the stock market crashes, I don't lose because my money is actually not in the house of straw in the stock market. I get to benefit when the market goes up, but when it goes down, when it crashes, I don't lose because my money is actually over here and I'm linking my returns to what is happening in the stock market without any risk when it crashes. Because the big bad wolf, and who's that? Some people say the IRS. Well, it could be, but the big bad wolf are the Hurricane Katrinas and Ritas and so forth, the 9/11 terrorist attacks, pandemics. These are things that we don't see coming, and it affects the stock market and the real estate market, and values will plummet sometimes. And so I like to keep my serious cash safely tucked in a house of bricks. My favorite is a max-funded insurance contract where I'm earning rates of return of 6 to 10% tax-free. But this is where I keep my real estate equity, and this is where I can participate in the market without the risk of having my money actually invested in the market. So I'm going to share how this works and why you may want to consider cashing out a 401k. And if you invest in real estate, don't do it the dumb way. Free yourself from the IRA 401k tax trap. How? Form a strategic rollout, not a rollover. So how do you do this? This is actually up to a 3-part strategy that I came up with years ago. Part 1 is to strategically schedule your withdrawals out of your IRAs and 401ks over, let's say, a 5-year period, maybe longer, based upon your tax bracket, any special circumstances during a given tax year. But generally speaking, my goal for most people is to get the taxes over and done with sooner than later over a 5-year period. We're trying to basically make sure that after 5 years, you don't have to pay tax anymore because of where you reposition the after-tax money. So a strategic rollout, first of all, you're getting the taxes taken care of sooner than later over a 5-year period, strategically based upon the tax brackets, the levels, your income, a lot of factors. Part number 2 in the strategy is to take the net after-tax monies from the rollout each year and reposition that into something that's going to be tax-free from now on. Now, most CPAs and tax attorneys go, well, what's tax-free? And that's why they come and enroll in advanced continuing education and learn about my favorite vehicle that I call the Laser Fund that allows you to accumulate, access, and transfer your money totally income tax-free. It actually will blossom at the end of the day, thus reimbursing you sometimes many-fold for any taxes that you did incur during the rollout process. So you, your spouse, your kids are not out anything at the end of the day. You actually come out ahead. So you're taking the net after-tax money in phase 2, and you're repositioning that in accordance with IRS guidelines under what is called the TAMRA tax citation, where you cannot fund a laser fund any faster than 5 years, or technically speaking, 4 years and 1 day. If you put in a lump sum at the first day of the first year, then the first day of the 5th year, which is actually 4 years and 1 day later, you have complied with the tax citation TAMRA, Technical and Miscellaneous Revenue Act of 1988, so that from that point forward, any money you access sooner or later out of the laser fund is totally income tax free. And when you ultimately pass away, it will blossom and transfer income tax free. Now, the third part of the strategy, sometimes we can't apply, but in any situation that I can, I will employ this, and it's to offset some or maybe all of the tax incurred during the 5-year or longer rollout process by creating or resurrecting new tax deductions that maybe you were killing, okay? This may be in the form of real estate that maybe you were owning. It was rental income properties or whatever, and you thought the best way to handle that is to hurry and pay it off, and you're killing your tax deductions. Or maybe it's your house. So I've had many people refinance and re-leverage or acquire new real estate properties, leverage them and bring in new deductions because of the mortgages, or resurrect deductions by refinancing those properties. And I'm going to give you some examples of this. And I've helped many people transfer $250,000, $750,000, $1.2 million out of their IRAs and 401ks, sometimes with no tax consequence, because I offset the tax by creating new deductions on their tax returns. The IRA 401k rollout is showing up on the front of their 1040 tax return, but under deductions, oftentimes on Schedule A or Schedule E of their real estate, I'm creating all kinds of new deductions that they had been killing, or I'm acquiring new properties, and people are able to get the money out with the least tax impact. So I'm going to share with you some examples of how this works. Let's connect the dots now with an actual story of a client that I had several years ago who had $600,000 yet to be taxed, trapped in his IRAs and 401ks. He was age 70 and a half, and unfortunately his wife had just passed away, and he had been deferring at the advice of his tax advisor, and not taking out any money because he didn't need it. Well, he had come to me at the end of that horrible decade, 2000 to 2010. He actually saw that $600,000 in his 401ks drop in value to under $300,000 twice during that decade. It was barely back to the $600,000 level. And his advisor said, okay, just hang in there. Let's take out RMDs, required minimum distributions. At the 4% rule, based upon the financial services industry standard, 4% on 600,000 would be 24,000 a year in a distribution, which met the RMD requirement. So he pulls out 24,000 a year, pays tax in a 33% combined federal and state tax bracket of about 8,000, and he nets 16,000 to buy gas and groceries or prescriptions or golf green fees or whatever. That's pretty pathetic. And so when he came to us, I said, you know what? You really ought to get the money out and the taxes over and done with sooner than later. Now, he also was a big real estate investor. He owned several duplexes and fourplexes, rental income properties. So what did we do? We showed him a strategic rollout. We got the money out of his IRAs and 401ks in 5 years. While we were doing that, we experienced a little under 8% rates of return, about 7.9%. So the 600,000 actually grew by $150,000 while we were getting it out. So we pulled out $150,000 a year over 5 years. Now, if we didn't have any offsets to that, he pulls out $150,000 a year out of 401ks in a 33% bracket. He would pay a third, $50,000 in tax, and he would have a net of $100,000 to reposition into a laser fund that's going to be tax-free from now on. And when he ultimately died, it would blossom and reimburse the tax that he paid, because over 5 years he pulls out $750,000. He only has a net of $500,000. So if he did that, $500,000 in his laser fund was earning between 8% to 10%. 8% on $500,000 is $40,000 a year of tax-free cash flow. How much better is $40,000 tax-free than a net of $16,000 out of his IRAs and 401ks? Substantially more. At 10%, it's $50,000. But what we did is we married the concepts together. He had a bunch of rental properties that he was paying off by taking the rental income and paying off the mortgage. And I said, wait a minute, you understand safe positive leverage, don't you? So we refinanced his properties and we took out the equity, put it into his laser funds, and he was able to earn rates of return at 8% tax-free versus the mortgages that he borrowed at 6%, some at 4.5%. That was a net cost of only 3 or 4% after tax. He was earning 100% more on the equity that he borrowed out, or the equity that he did not put into newly acquired properties with the refinancing, and the money that he took out of his 401ks. So he kept all that money in his laser fund, earning rates of return at least double and sometimes triple the net cost of the mortgage. He said, Doug, I am earning so much money since I met you. What am I going to do with all this money? Yeah, he was so thrilled, but you know what? The strategic byproduct that came along for the ride, the new tax deductions that we resurrected on his existing properties and that we created from the new properties he was able to purchase allowed him to offset the tax on the $150,000 he took out of his 401ks. So he took it out, reported it on the front of his tax return, but it was washed away with the new deductions that totaled enough to offset the tax. We were able to get out $750,000 with no tax consequence. Folks, we do this all the time. I would recommend you learn about stories like this, how you can determine, golly, should I cash out my 401k to buy real estate? Should I buy more real estate? How should I buy it the smart way? Hopefully this has been valuable for you. So how can you learn more? If this has piqued interest, I would love to gift you a free copy of my most recent best-selling 300-page book, The Laser Fund, which is actually 2 books in one. This book here is about 200 pages, comprised of 14 chapters with all kinds of charts and graphs and explanations of how to diversify and create the foundation for a tax-free retirement. Now, if you learn more right brain with stories and examples, you flip the book over and read this one. This is about 100 pages, 12 chapters with 62 chicken soup for the financial soul stories like the one I just told you. If you like to use your whole brain, I would recommend you read both books. But it's 300 pages. This has been flying off of our warehouse shelves. I'll tell you what, I will pay for the book. You go to laserfund, L-A-S-E-R, fund.com. It's on the screen here. And claim your free copy. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will send out a book to you. There's also options there for you to listen and learn and watch and learn. But here's to your brighter future.